Welcome back, everyone, to the Bitcoin Business Bureau. I'm your host, as always, LitecoinLeader. Today, I'm continuing this series talking about different complicated things in the financial system that they created, and they're complicated for a reason. They don't want you to know what's really going on. Now, I've talked, and I'll share them up here when I can remember that I do this right. Hopefully, I get all this right. I'm the one-man band. I'm doing all the editing. I'm doing all the videos, all the production, all that cool stuff. It's fun. But hopefully I remember. If not, just check out my other older videos. But I'm going to talk about I've talked about mortgage-backed securities. I've talked about fractional lending, but I'm going to build on the mortgage-backed securities to talk about credit default swaps and what those are. Now, I'm going to say this again. Well, let me remember to say this at the beginning because I always forget. Please like, share, subscribe, hit the notification bell. Really helps out the channel. If you like this kind of content, please share it to someone who may need to know about it, may want to know about it, wants to learn about this channel, interested in this topic. Helps out my channel too. Post it on Facebook, post it on Twitter, Instagram, wherever you want to share it, please do so. Now, credit default swaps. That is a very complicated term that people made up back in the mid 2000s. And what it is basically insurance. So a credit default swap is so let's take it one word at a time. Credit. Okay, so it's going to be based on a loan of some kind. So there's credit. Now, credit default, that means you default on the loan. So let's just say you have a mortgage and you don't pay it. That would be a credit default. Okay. So let's just say you go back to the mortgage-backed security example and you have a stack of cards. One more time. All right, you got a stack of cards. It's got some aces and twos, all different kinds of products in here, but you got a bundle. You have a bundle of mortgages. This is a mortgage-backed security. So it is one thing to the street. All right. So now let's just say I'm going to pick a bank at random. I'm going to call Blankety Bank. Okay. So Blankety Bank owns this mortgage-backed security. They're concerned that, all right, they're told that the odds of this, there being too many mortgages that default in here, the credit defaults in this mortgage-backed security, the odds of having credit defaults of over 1% are like 50 to 1. Okay. Maybe it's 100 to 1. Okay. And they have ratings that the rating houses, the Moody's, and I think it's Barron's. I forget the other one that does the rating houses. But if you know what it is, please leave in the comments below. So that way we help each other out. I learned something. I'm always ripe to learn something. And if I ever get something wrong, please correct me. I'm always open to that too. But Blankety Bank owns this mortgage-backed security, and they're concerned that their mortgage-backed security might default at a higher rate than expected. So they want to hedge their risk. They want to outsource their risk. So what they do is they get an insurance policy called a credit default swap, and they swap their risk on this. So Blankety Bank has, all right, these names are stupid. I'm going to pick Chase and Bank of America because I can say those two things very easily. So Chase has 10 of these and Bank of America has 10 of these. They're about the same risk on paper, or at least on the front of everything. But, they just don't know what the underlying risk really is. So what they decide to do is that we're going to do a credit default swap. So I'm going to take some of your risk while you're going to take some of mine. So if I have $1 million, if I have $100 million of mortgage-backed securities, the chances of, let's just say I'm going to take insurance that 10 million out of 100 million of them defaults. All right. And that insurance policy might cost me $1 million. Okay. I will take that $1 million out against your bank and you take it out against mine, or you swap your risk policies so that you're spreading your risk. Like you've got your own mortgage-backed security, but you take some of your risk and sell it while you buy someone else's. So now, this is how incestuous it gets in the banking. So now Chase owns some of Bank of America's risk. Bank of America owns some of Chase's risk. So they've done what's called a credit default swap. So now if these securities ever go under, the idea was Chase Bank has now offset some of their risk to Bank of America. Well, Bank of America also offset some of their risk to Chase. If something goes belly up on either one of those products, both companies are now affected, but not to the same degree. Same example, $100 million worth of mortgages. Let's say they all go belly up for Bank of America. $100 million loss for Bank of America. Okay. But if they sold some of their risk over to Chase, now let's just say they sold half of their risk, right? They sold half of the risk. So now Chase is going to have $50 million of risk that they had insurance against it. And now Bank of America had $50 million of risk that they insured against. And then the insurance providers got to pay out at a rate that they didn't expect. But the $100 million, instead of $100 million being under one entity, under Bank of America or Chase, now it's split across two. Now, all the banks started figuring all this out, and they started swapping amongst themselves to spread all the risks. So now everybody is exposed, but equally. So now it doesn't matter who you got your mortgage with, because everybody's got credit default swaps, because Bank of America, Chase, JP Morgan, PNC, Wells Fargo, all these big banks, B of A, they all have their mortgage products and they all have risk, but they've all swapped them. Now, like other entities, pension funds, other investment funds buy into these, and they also buy the credit default swaps, right? There's a risk as a hedge, or there's a hedge fund that buys a bunch of credit default swaps and hoping that the real estate never goes under. Or in the case of Michael Burns, I think I got the name right, but I hope I got that name right. I should know what. All right, it's Michael Burry. Michael Burry, not Michael Burns. Michael Burry created a hedge fund where he went all in against the real estate in 2005 or so, because he thought the real estate market was going to go under because people over leveraged and these mortgages had way more risk than they were exposed or assessed for. So he actually went to the companies and got insurance policies created against things that people said that these never default. But he was able to buy insurance policies against these mortgages that never existed before, and the bankers were laughing for him to bet against real estate, because real estate never goes down. Well, instead, what happened is that it did go down in 2008. Nearly the entire banking system in the United States went down, and almost in the UK as well. A number of almost all over the globe, all the banks went down because the real estate was imploding, and the governments had to intercede and be too big to fail and bail them out. But Michael Burry was right. He was right. Is that the perceived risk was not the same as the actual risk. And now, long-winded story, to bring it back to crypto, that's been the story of the Bitcoin for years. The perceived risk is way less than the actual risk. Now, this is of the actual Bitcoin, and assuming you stored it properly, you have it, but the asset itself, Bitcoin itself, is it going to go to zero? Is it worth nothing? Is it a big nothing burger? Well, Bitcoin, the risk associated with Bitcoin has less risk than a fiat currency, because that's a gamble on a government. You have faith in the government, or you have faith in Bitcoin. You have faith in the Bitcoin network, faith that it's going to keep running, faith that the fact there's only 21 million of them, and it's the only asset class where we know exactly how much there's ever going to be, versus a system that has fiat currency where you can print more of this stuff at any given moment and devalue it all. So which one has more risk, Bitcoin or a fiat money system that none of them have ever lasted ever? All 100% of them throughout the last 5,000 years have all ended, and ended badly. Usually ends badly. But that's what a credit default swap is. It is a risk. It's a risk management tool. If you do it right, it's helpful. But if it all goes belly up, everybody goes up all at once. And that's what happened in 2008. And that's what we're on the verge of happening again, not just with credit default swaps, but mortgage-backed securities and commercial mortgage-backed securities, which is just another version of mortgage-backed securities. It's just commercial properties. So these are complicated things, but they want it to be complicated because they don't want you to understand what they're doing with your value, with your hard-earned currency that should be money, but it's not. It's not backed by anything. It's fiat. It's backed only by faith in the government that issues it. If it was silver or gold or Bitcoin or other assets that hold their value over time, that could be deemed money. But this clearly doesn't. We've seen the charts before since 1913, where they below a penny on the original buying power. It's in the death spiral. No one alive has ever seen a world with the U.S. dollar, but we may see it real soon. So, lots said today. I'm looking forward to your comments. Please like, share, and subscribe. With all that said, I'm going to close the door on the bureau, say follow the leader, and I will talk to you soon. Take care.